Hey traders, welcome to Charts and Coffee. Hope everyone is having a good morning. We've had the ADP number that was released, and it's just a really great way to get that countdown and that psychology behind non-farm payroll, which is coming up on Friday. Now, when we think about non-farm, we're talking about the second biggest metric, probably second only to maybe that PCE CPI type combo. In other words, what is it that we're dealing with in terms of what the Fed is looking at in terms of jobs, and also in terms of what it is we need to remember that will map to, we need to track that, what will map to ultimately when on earth are we going to get that first rate cut. Now, please remember, a lot of folks ask, Rog, what if we don't get the cut? Remember, we're not trading the cut. We're never trading what's necessary. Well, I shouldn't say never. We're usually not trading what's happening. We're trading the expectation of what may happen. And then once we get the information, once we get the reality, then oftentimes there is an abrupt, sometimes very volatile reaction to that. But at the end of the day, just expectation is enough. Just anticipating that the Fed could cut or they're open to cutting is enough. And that's where a lot of traders get caught up in the, well, they're not going to cut. Doesn't matter what they're going to do. I don't know what they're going to do. They may not even know what they're going to do. But we do know what's expected. And expectations move a market. And so, probably no better example of that is something like NVIDIA, right? And think about the logic of your average retail trader. Now, your smart traders are just saying, look, the sheeple are going to run in to buy NVIDIA before the split because after the split, they get 10 for 1. Well, let's call it $1,000, right? So if the shares are $1,000 on the day of the split, they'll spend 1,000, get 10 shares. The day after the split, they could spend 1,000 and get 10 shares. But that's the logic of typical retail investors. Now, traders are smart. The smart ones anyways are going to say, look, we know sheep are going to trip over themselves. Let's just take advantage of the movement. But we also know what traders will do as well. Are we hanging in there in June 6th to get the 10 for 1 split? No. What we're doing is taking advantage of the movement higher in anticipation of that. And in reality, there's probably going to be a healthy amount of profit taking. We're likely not going to see a new high in the days after the split. We're likely going to see profit taking, AKA selling after the split. But again, think about anticipation, right? What we do as we expect something, and then what we do when we get the reality. And that's always that tug, that push and pull of trading. And as long as we don't get caught up in those things, and we can remember what the catalysts for the moves are, we can just trade what is, right? Not what will be, not what we'll predict, etc. So that is what we've got right now. And, in terms of non-farm, there is also another type of mindset. And this is very common with data. We don't know if the non-farm payroll is going to be higher than expected, which would likely trigger weakness in the indices and bonds, by the way, or if it's going to be lower than expected and it sends indices and bonds higher. Now, this is still a good news is bearish, bad news is bullish environment. So we don't know what's going to happen with non-farm. So would I expect the S&P to stay stuck in this range? Likely, because neither CPI, PCE, or even non-farm, well, I should say the previous non-farm was enough to convince traders that the Federal Reserve is looking at the data, the two mandates that they have, and are thinking, well, we've got to cut sooner. In fact, we're not even sure about the September cut. We should have a better expectation after NFP on Friday, but we just don't know. So there's another type of anticipation, which is the uncertainty and staying in a range because we don't know what that final result is going to be. And that's likely the reason why I would anticipate between now and Friday that we'll stay somewhere. If we do keep moving higher, we'll stay somewhere capped around that 53.62 area, because again, who wants to stick their neck out in front of NFP? So those are all things to think about. And that's where we are this week. And in the meanwhile, there's some pretty good short-term swing or day trading opportunities. And that's to say, how do we get out of a trade sooner, right? Day trading is the ultimate example of that. And short-term swing trading would be, hey, what can I do Wednesday to maybe Thursday's close? So one timeline would be trade up until NFP, hit the reset button and start looking at new opportunities, or have a time frame and a setup that's got enough shock absorption so that as we get through NFP, we could hold through that. And those aren't matter. It's not a matter of right or wrong, right? It's not even really a matter of right or wrong. It's really just a matter of what you're comfortable with in terms of risk. By the way, I do want to mention, so I got some pretty good feedback on it, that over at the Simpler Trading YouTube channel, a lot of folks have been asking me about how I trade S&P. And look, S&P right now, the parachute pants trend of the market is, hey, everything's about SPX. So, hey, let me just put a little SPX action in there. But the truth of the matter is, SPY, ES, MES, these are all different ways to trade the S&P. So I call it choose your own adventure. Check out the video. I talk about how I have found, whether it's 0 days to expiration SPY or 0 days to expiration SPX, how would we look at price action using the nearly 24-hour view of the S&P, which is the ES mini S&P futures. And if you start getting used to looking at the ES for every other variation of the S&P, you'll find you really do get an edge on traders who are looking solely at SPX or solely at S&P. And check it out. Don't take my word for it. Check it out. I laid out everything that I look for in that video called SPX Levels to Watch. And give it a whirl. Take a look at how price action behaves. We'll be doing that in the Sector Secrets Mastery this morning. All right. As always, if you have any questions, feel free to type them in. David, I appreciate that. And again, I'll be straight up. I put SPX in there. You know why? Everyone's got their brain on SPX, which is cool and partially very misplaced. It's one way of trading SPX. So thanks for watching. I think once you watch that video, you'll say, oh gosh, yeah, Rog, I could trade micro S&P. There's a smaller version of the SPX called the XSP. There's of course, the micro futures and the ES themselves. And then I didn't even get into the options on the ES. Now, a lot of folks have asked, Rog, I'm slowly getting into futures. And this is something I've been trading for darn near, oh gosh, over 30 years. And the thing about futures is this. Yes, there's no pattern day trading rule with futures. But by the way, if you're in a cash account for options trading, there's no pattern day trading rule there either. Long calls, long puts, it's directional, right? So if I want to be trading S&P, but I want the options on the S&P, does anyone here think that there's a different kind of setup for the options on the S&P versus the S&P itself? Not at all. If I want to buy ES on a limit buy, I can also buy ES calls with a limit buy as well. And that applies to the micros. So futures don't have a pattern day trading rule, but they are highly leveraged and they're not exactly inexpensive. So a lot of folks ask, Rog, if I want to get started with S&P and I want to be able to choose my own adventure eventually, how would I do that? And I would say start with SPY options. And one of the things that we teach in the mastery is how do I keep it? In fact, we did this yesterday with bonds. We watched ZB, and a lot of traders bought the bond futures when they sunk down to their day trade level that we wanted to trigger a trade at. And other traders bought calls on TLT. But what all the Sector Secrets Mastery folks did is they were looking at the futures contract for the TLT or the futures contract, of course, for the futures. And if you're looking at the ZB futures, think about all the offshoots. Choose your own adventure. We have the futures contract itself. We have options on the futures contract itself. And of course, TLT. And they all share the same trigger. So it's not difficult. It's just a matter of thinking, oh, that is something I can do. So keep that in mind. And if you haven't checked out the video, I think you'll probably find that pretty darn helpful. All right. First question of the morning. Thank you, Trader Momo, is asking about Meta. All right. So let's take a look at META. Seems to be consolidating. Looks like an opportunity. So this is the way I look at any kind of consolidation. It could consolidate for a long time. This is why I don't like necessarily narrow ranges, because look how long it's been going sideways, about 3 weeks now, right? So the first question is, what could be a catalyst for the breakout? right? And that's really what the most challenging thing about trading any compressed market is. How far out do I have to buy my option in order to still hold a call, for example, in Meta and still be able to take advantage of the breakout and then have some time left to take advantage of the follow through? So consolidated markets, while a lot of folks love them, I don't. However, here's another way to look at it, Trader Momo. First of all, your best trading is going to come in trends. And I don't even hedge that. Most traders do the best when something's trending. Now, that means we're not in a range. That means we're seeing higher highs and higher lows. That means the markets are stepping higher. We buy the dip. We go on our merry way. We look for the follow through because a follow through is more likely in a trend. However, here is how I would recommend, and this is how when I do trade a narrow range. So first of all, I prefer a slightly wider range, and here's the reason why. If I'm going to trade a choppy environment, let's just call it choppy. If it's a little choppy, I can buy at the bottom of the range. And notice my Darvis, automated Darvis level, defined the whole range. So I don't have to do any subjective analysis, right? So there's the range. If I can buy calls at the bottom of the range, that at least gives me an opportunity to take some profit at the other end of the range. So I don't have to sit hopelessly and haplessly for an opportunity to pay myself or at least move to break even. And by doing that, by taking some profit or moving to break even at the other end of the range, if finally, I mean, look at how many times we've tested this area and haven't broken through. If finally I break through, great. At least I paid myself and then I can take advantage of the movement. But the days to expiration is still a problem. And that's where a lot of traders find a compressed market. They're waiting for a momentum breakout and they're just waiting and waiting. So what I say is if you're stuck in the waiting room, why not get a good seat, right? Why not get that seat near support rather than what I do not recommend, which is buying through the resistance or even worse, buying at resistance, because then this is all an unrealized, this whole range becomes an unrealized loss and you're waiting and waiting and waiting. And because the call was bought at the upper end of the range up in here, there was never an opportunity as we went back and forth to pay yourself. So as a general rule, I don't like sideways markets. However, there is a way to trade it. And when I do, that's the way that I'll do it. So I hope that helps. All right. And by the way, if you want more strategies like that, like, hey, Rog, I've never heard someone talk about automating the support and resistance and buying at the lower level in anticipation of a breakout, but still having a profit target to focus on. If you've never seen stuff like that, come check out what we're doing in the Sector Secrets Mastery. This is very basic technique that we use day in and day out in terms of using support, using resistance, having optional targets, and using those to our advantage. And you can check out what we're doing at sectorsecrets.com. And I'm mentioning this because in just 2 days, the Memorial Day sale is over. So it ends on the 7th. And right now you can pick up hourly price movement ranges, daily price movement ranges, as well as the Sector Secrets Mastery membership for 30% off. So if you can save some money, I'm a big fan. Whatever you save, you're able to put in your trading account, and I'm all good with that. All right, next up, Larry asks, for a covered call, is it better to close the position if the stock price far exceeds the call price or let the stock be called away? Larry, I don't have an answer for that. It depends on your target. It depends on what your ambition was for that covered call. I'd need to know a little bit more. But here's what I'll always say. There should always be a target. There should always be a level at which you want to pay yourself. And ultimately, if you're doing something like that, once you get in, you know your risk based on what you paid, or maybe you sold, right? So there's still risk based on taking a credit, right? How much credit are you willing to let go as you're waiting for the trade to do what it is you thought it was going to do? So I guess my main question is, what was your target? And then respect that. And if you didn't have one, that's probably problem number one, which is to have a full blueprint in trading. We have to have where we're going to get in, where we want to take profit, and how much of our trade are we willing to risk. in that interim. All right, next up, and by the way, again, that applies to credit too. A lot of traders think once I've collected a credit, I win. We know that's not the case either. There's always risk involved, whether it's a debit or whether it's a credit, right? All right, mRNA based on the daily. John, this is a mean reversion. Yeah, this is a mean reversion setup. We've actually hit the 21 propulsion. This here, the green, yellow, and red is your mean reversion, at least mine. There is no widely accepted mean. Some people like a 13, some people like a 20 simple. I like a 34 zone. But whatever your mean is, at least mine's getting very close, and it is a mean reversion. And that's specifically a tactic that I would consider in a trend and in a trend alone. So yes, I like the swing on the daily. I would keep more time to expiration, probably no closer than June 21, and then look for the dip into the mean zone. I like to buy an at or slightly in the money call and then let that direction do the heavy lifting. All right. Okay, next up is Zane asked, do I buy Delta 70? All right, so let me tell y'all something. I'm going to sound like a heretic, but this is the way I've been trading futures options, stock options, ETF options for my entire career for 30 plus years. I don't look at Greeks. Zane, I don't even look at Greeks, not for a second. Here's the thing. Greeks are calculations of, think of all the things we're looking at: volatility, price, time. I can do all that by looking at the chart. So if I'm going to buy, I can tell you this just because people have told me this. As a general rule, when I buy a call with the technique that I use, again, not looking at Greeks at all, I hear so much about deltas and thetas and gammas. And you know what's funny? Every time I hear people talk about it, especially gamma, it's so mind-bogglingly confusing. And I know some people say, Rog, gamma's easy. When I hear people talk about gamma, their tongues get tied into a knot. It's hilarious because it's a difficult concept. And even if you understand the concept, is there necessarily a trade behind it? I don't think so. I think there's a trade when price falls to a certain level, and I expect the trend to continue, and I have enough time left on my option for it to continue. And so I have found that for the most part, yeah. So Zane, to give you the best answer I can, it's about a 50. It's usually not quite as high as 70. It's usually above 50, but not as high as 70. But the bottom line is in or at the money. And I will say this again, not hedging at all, never out of the money. And remember, out of the money calls are used by traders who typically use max debit, and it's too expensive to buy an at or in the money call. So that's the way I've noticed that traders tend to navigate their way through spendy options and making things affordable. My 2 cents. Thank you for the question, Zane. I appreciate it. So slightly in the money or at, that answers it. Awesome, because I really don't know the answer to that. I just don't use Greeks. I'll tell you, a Greek salad, pretty good with some grilled chicken. Greek yogurt, Greek yogurt uses a lot of water. I've heard some bad things about how Greek yogurt has to be made. I'm more of a fan of Bulgarian, actually. Be careful, gang. Be careful. All right. All those Greek decisions. Be good to each other, gang. I'll talk with you soon.